We cover valuation in a wide range of courses here at CFI, but valuing a bank presents multiple different challenges. We need to understand those challenges as well as what makes a bank different from a typical non-bank. Understanding these differences is key to proper bank valuation. Hi, I'm Scott Powell, co-founder of CFI, and over the last 30 years, I've had the privilege of working with firms like JP Morgan and Deutsche Bank, teaching specialized finance skills to countless professionals like you. This introduction to bank valuation is designed by myself and my colleague Jeff Schmidt to cover the most common bank valuation techniques. You'll learn why we do not calculate enterprise value for banks and why we must consider regulatory capital in our valuations. Before taking this course, we highly recommend that you have completed our Introduction to Business Valuation, our DCF modeling, and our comparable valuation analysis courses. This course begins with a brief discussion on the difference of banks compared to regular companies. We're then going to move on to discuss why we value a bank's equity directly as opposed to calculating enterprise value. As part of this, we will discuss the most common bank valuation methodologies, including the dividend discount model, the residual income model, comps or comparable valuation, and marking a bank's balance sheet to fair market value. Throughout, we'll use interactive case studies, hands-on practice, and an assessment so that you can apply what you've learned. Now, let's get started on the fundamentals of valuing banks.
In this course, and by the end of the course, you'll understand what makes a bank different from a regular company. You'll also discover why enterprise value is really meaningless for a bank and analyzing a bank. We'll also explore and you'll be able to value a bank using a dividend discount model. You'll be able to calculate the residual income of a bank, apply multiples and regression for bank valuation, and finally, learn how to mark a bank's balance sheet to market value. So let's get started. Now, valuing a bank or other financial institution is really quite different from valuing a non-bank, or what we're going to call a regular company, for several reasons. First, the nature of a bank's business makes it difficult to define what is considered debt, as well as what is considered reinvestment in the business to create growth. Additionally, banks are very regulated compared to most regular companies, which has a direct impact on valuation. Let's look at the differences between a bank and a regular company that sells a product. A typical income statement for a regular company might look something like this. Notice that the regular company has operating income or EBIT, and then interest expense is below operating income because it's considered a non-operating expense. That's because the regular company has discretion over how to finance its business. It can use all equity or a mix of debt and equity. Basically, the financing decision is separate from the actual operations of the business. Okay, so now let's think about a bank. A typical bank income statement might look something like this. Notice that a bank doesn't have sales revenue. Instead, a bank earns interest on money it has loaned, like business loans or commercial or residential mortgages. Similarly, a bank doesn't have a cost of goods sold. Instead, a bank pays some interest out to depositors or debt investors. Debt is effectively a raw material required to operate a bank. Now, because of this, we cannot separate the operations of a bank from how it's financed. The financing of the bank is directly linked to its operations, which is different from a regular company. At its core, a bank makes money on the difference in the interest rates on loans it gives and the interest rate on the deposits it takes. Now, remember, from a bank's perspective, loans are assets, as loans are effectively an investment that will generate future cash flows. Now, conversely, deposits are actually liabilities for a bank. Customers deposit money at the bank, which in turn allows the bank to lend that money out. However, in general, deposits can be pulled from a bank at any time, and these deposits are obviously owned by customers. So in a sense, loans can be thought of in the same way as inventory and property, plant, and equipment is to a non-bank. It's really investments in assets expected to generate future cash flows. Deposits can be thought of as similar to, let's say, accounts payable, liabilities owed to another party that will decrease future cash flows. So let's look together into this in more detail. Okay, so debt can actually be difficult to define at a bank, whereas it's usually fairly easy at a regular company. At a regular company, we typically define debt as any interest-bearing liability. But for a bank, it's not that straightforward. So for example, customer deposits. It's a liability from the bank's perspective and is key to the operations of a bank. However, banks may pay interest to many deposit accounts. In that case, it's an interest-bearing liability. So the big question is, are deposits a source of financing or the equivalent of a raw material for a bank? Because this separation between operations and how those operations are financed isn't truly applicable for a bank, as opposed to a regular company, we can't look at a bank's enterprise value. Instead, we focus on equity value. Regulators also reinforce this distinction by narrowly defining a bank's regulatory capital, which is mostly equity-based. Now let's discuss reinvestment. Reinvestment in a business is necessary for future growth. We can fairly easily determine what is considered reinvestment by a regular company. Increase in net working capital and investments in long-term assets like property, plant, and equipment are typical types of reinvestment. We factor in the reinvestment when we calculate free cash flows. However, for a bank, these items are pretty negligible, as there's no inventory and very little PP&E. So what is a bank's reinvestment? Well, really it comes down to just two things. First, employees, with this expense being recognized in net income, and then secondly, increasing its regulatory capital. Again, that means primarily equity capital. Now, if a bank wants to grow, it will need to increase deposits, which it can then lend out to generate income. However, due to regulatory requirements, a bank will also need to raise equity capital as well. Equity capital is a buffer to make sure that if the bank runs into any financial issues, deposits will be protected. Equity capital is raised if the bank can issue new shares, as well as when it retains net earnings. Now, this puts a real limit on how much cash a bank can pay out in dividends, since dividends reduce the book value of equity. So this inability to measure reinvestment is a real problem with calculating free cash flows for a bank, as well as the difficulty in estimating future growth. Even if we could measure a bank's free cash flows, the bank can't pay out all of it as free cash flow. It will likely hold back some of the cash flow to support the dividends should the bank's operating performance deteriorate. Now, dividend-paying companies, whether a bank or not, like to maintain relatively stable and predictable dividends. So by holding back some free cash flow, the bank can continue to maintain the stable dividend. Additionally, a bank will have to hold excess cash in case depositors withdraw funds. So what does all this mean for bank valuations? Well, the bottom line is simply this. Since we can't separate out a bank's operations from how the bank finances itself, it means that we can't look at enterprise value when valuing banks. Now, if you've taken our Introduction to Business Valuation or comparable valuation analysis courses, then you'll recall that enterprise value is the value of a company's operations and is capital structure neutral. We can only define enterprise value if we can separate a company's operations and how those operations are financed. We cannot do this for a bank. A bank's capital structure is directly tied to its operation, so calculating enterprise value for a bank really doesn't make any sense. Therefore, we never calculate a bank's enterprise value or use unlevered metrics. So instead, we have to focus on equity value or levered metrics. Recall that levered metrics are things like net income and book value of equity. Both of these metrics are after interest expense has been deducted, so we say they are levered. Unlevered metrics like EBITDA are before interest expense has been deducted. However, although we can't use unlevered metrics, we can still value banks using the same general methodologies as we do for regular companies, using either intrinsic or relative valuation methodologies. At the end of the day, when it comes to business valuation, there are three main valuation techniques: the income approach, the market approach, and the asset approach. We'll first discuss the income approach, which is also known as an intrinsic valuation. Intrinsic value means that we look at the company in relative isolation. In other words, we are focused on the cash flow generation potential of the bank. For regular companies, the most common intrinsic valuation is the discounted cash flow or DCF valuation. However, due to the reasons we've already discussed, especially around reinvestment, we don't typically value a bank using a DCF, not even a levered DCF. Instead, we focus on the amount of dividends a bank can pay and value the bank based on this. Now let's take a look at relative valuation. With this approach, we look at what other banks are worth and use them as a proxy for the banks we're trying to value. So there are two commonly used relative valuation methodologies, and the first method is to look at comparable banks that are publicly traded. They're relatively easy to find because these bank shares are publicly traded on a stock exchange, so we can see their price at any time, and then we can determine what other investors are willing to pay for the target bank stock. If their peers are similar to the bank we're trying to value, then we can use multiples to figure out what the bank we're trying to value is really worth. For example, we can use the price to earnings, the price to book, or the price to tangible book multiples. Now, the price to earnings multiple relates to a bank's equity value or market cap and compares it to its net income or net earnings. The price to book, in contrast, compares a bank's market cap to the book value of its equity, and the price to tangible book is very similar to the price to the book, only we deduct the book value of intangibles from the book value of equity. Now, if we can find good comparable banks, we can take the average or median price to earnings or price to book and apply that multiple to the target bank's net income or book value to figure out the target bank's equity value. Now, this valuation methodology is more likely to reflect the mood of the market and produce a valuation that is closer to the market price than the dividend discount model valuation. Now, the other main relative valuation approach is to look at precedent transactions. Now, precedent transactions really means past mergers and acquisitions, where we can see how much an acquirer paid for a bank. This form of valuation includes a takeover premium because generally more money is paid for a controlling position in the acquired bank. Now, taken together, these two forms of market valuation can provide a good overview of what a bank might be worth relative to other banks. And for the purposes of this course, we aren't going to cover precedent transactions. Just note that precedent transactions analysis is very similar to using comparable company analysis, but results in a higher valuation due to the control premium, which we discuss in other valuation courses. Again, as a reminder, precedent transaction analysis for a bank is still focused on equity value as opposed to enterprise value. Finally, we have the asset approach, which focuses on determining the fair market value of individual assets. While this methodology isn't very relevant for regular companies, it is more useful for banks. And the reason is that regular companies record most of their assets at historical cost, while banks use mark-to-market accounting for many of their assets and liabilities. Therefore, the balance sheet of a bank is closer to true market value than a regular company. And if we have enough information, we can calculate the market value of assets and liabilities. And if the market value of the assets is greater than the market value of the liabilities, well, what's left over has to be equity value. This methodology obviously assumes that the assets and liabilities can be sold or disposed of separately from the bank at their current market values. Here we have a summary football field chart where we express all our valuation ranges using the techniques we've talked about: relative valuation, intrinsic valuation, asset approaches, and so on. By the end of this course, we'll have completed this football field chart in Excel, So I'm super excited to get into it right away. As you see on the far left, we have two relative valuation techniques. It might be hard to read, but we're going to do comparable companies, but also something called regression. Then we move into intrinsic valuation techniques, and the DDM stands for dividend discount model. So we're going to look at two different types of dividend discount model and something called residual income. And then we'll finish with an asset approach, or you can see there it says net asset value. And we can see and compare that to the current trading price of the stock. So you can see a 52-week high and low of 1850 and 23. So let's get started building this model in Excel.
Continue learning. Join CFI today.